expenses and all the stuff, RS is deleted and our allowance is decreased. So our allowance balance is now 89. So what happened here? You see, our net account receivables are the same. So we missed this entry here. So now I'm going to explaining that one. So you see here in our example here, we had RS, TM, another receivable this much. So our total receivable are 1108. And we established in our planning, in our budget, allowance 98. So the total value of our account receivable on the balance sheet would be shown 10,930, right? Now what happened? RS says, I'm not going to pay you due to some reason or whatsoever. He's insolvent or whatsoever, right? He's not going to pay us. So now this is the beauty of, allowance, smart management. So we will adjust this against the account receivable so that our net receivable is not disturbed. So we make the entry, we charge this 9, we charge RS to allowance. So allowance for uncollectible to account receivable RS. And what happened? We deleted the RS account, charge the uncollectible to allowance. So what happened here? Our now total account receivable is 11,019, and look at the beauty here. We still have our net account receivable, which is 10,930. So our amount on balance sheet is not disturbed. It means everything is according to plan. In our planning, we said that our net account receivable would be 10,930, right? So even after RS refuses us to pay, we already established that 98 is not going to be received and 9 is one of them. So our planning is not disturbed. Our total account receivable on the balance sheet is the same, 10,930, right? So this is the beauty of, having a smart management. In advance, you make a budget. So what happened during the year? You charge all those uncollectible to the budget. Why? Because you establish at the start of the year, our account receivable would be 10,930. So it's remain 10,930. Right? So you see, in before write-off, what happened? We also call this write-off. The accounting name for this is called writing off. Means during the year, what happened? RS refuses us to pay, so we need to write off. We need to delete that one. We need to remove or close his account, RS account. So you see, previously on balance sheet, our account receivable was 11,028 minus 98 was the budget. The total amount would be 10,930. After writing off, we charge it to allowance so that our planning is not disturbed. You see, our planning is not disturbed. This is called smart management. So smart accounting, do plan for everything in advance. Florian, Lota, Fabian, Kathleen, understand? Anis, Dijodi, Wuxiong, right? So that is why I told you the smart management is you plan in advance, right? Proactive management, right? So like we already discussed this. So percentage of sale method will give you the expense. So if this is the uncollectible, if this is allowance, and this is balance. So the percentage of sale method will give you this amount, not the total amount. For the total amount, for example, 100. So if this is 10 here would be 90. So percentage of sale method will give you the 90 amount, but aging will give you this 100. So that is just a difference between these two methods. In allowance, percentage of sale method will give you the during the year expense of the allowance of uncollectible, while aging of receivable method will give you the total balance of allowance. So if I were to find out this year, you need to rearrange the equation, rearrange the account, and you will find out the balance. That's it, right? So let's do just the real, implications here. So real example here. Let's just talk about this, and I'm gonna do it with you, with your participation. So we will do it, in a very slow pace, so that all the concept that is still fresh in your mind, you can digest, properly. So here we go. Be very attentive here. On November 30, High Peaks party planners had 34,000 balance in account receivable. So they have already balanced. So this balance is debit or credit, because account receivable is our asset, and asset normal balance is debit. 3,000 credit balance of allowance for uncollectible. So they already have the credit balance of allowance for uncollectible debt. Well done. During December, High Peaks party planners made credit sales of 159,000. December collection on account were 130,000. Right? $130,000 has been collected. And write-offs of uncollectible receivables total 2,700, which means among this 159, or among the total, or if we draw, okay, in our next page, we already have done. So among our receivable, $130,000 has been received, $2,700 is bad debts or uncollectible. So we establish uncollectible based on percentage of sales, 1% of the credit sales. So in this illustration, how much is the credit sales? 159,000 here. Credit sale 159,000. Right? So 1%. So first of all, generalized sales, collection, write-offs of uncollectible and uncollectible expense by allowance method during December. Explanations are not required. So it means you just see the numbers here. So here. So you pick up the right words, because we need to record the sales, we need to record the collection, we need to record the uncollectible. Okay, let's just talk about this. So credit sales happen. So what is the credit sales? When your sale happen,
so
what is
we account receivable, if we are credited account receivable.
What is the entry for this credit sales?
Is
what is debit?
cash.
What is credit?
It's credit. No, it's debit. Sorry.
What
when
is
the asset increase is debit.
So what is the entry then?
Cash 100.
Cash is not included here because this is credit sales.
So is account receivable?
Account receivable. We create customers.
Yeah. Account receivable 100.
Account receivable to sales. Simple. Account receivable to sales 159,000. So collection is 130,000. So it means customer paid us 130,000. So customer is going to decrease, cash is increase. Increase in cash debit 130,000. Decrease in account receivable credit. Now what happened? Allowance for, so how we charge this write-off? So we just charge this expense to, allowance for uncollectible to accounts receivable. Right? Simple. Understand? So these two entries are obvious. We already talked about this. So this entry is new because we need to write off. So writing off always against allowance. So this is expense, yes, but we will charge this expense to allowance because smart management already established this reserve in advance for uncollectible, right? Here we go. And now they said we need to we need to establish estimation for 1% of credit sales. So 1% of credit sale is 159,000 multiplied by 1%. Answer would be 15,900. So when you make estimation entry would be expense to allowance for uncollectible, right? Sorry, 1% would be 1590, right? Here we go. Understand? Since this is sale method, percentage of sale method, this estimation will give you this. If it would be aging method, the result gonna be this. But since it is percentage of sale method, so we would be given the this year expense, right? This year expense. So what is it? We still have time, right? What is the time here? Yeah, we still have time. Right, guys? Understand? So the actual write-off we will be charged. The point here is that the actual, so this is the estimation, right? 3,000 is the balance. The question already gave us. Well, we write it down. Credit balance here. So this year, our estimation would be that this much expense would happen, 1590. But during the year 2700 in December is just bad debt. It's uncollectible. So we charge those uncollectible to allowance, right? So it's like, let me give you the idea here. You still don't understand. So basically, at the start of the year, so at the start, what happened? You create a reserve. You create an allowance. Why I cannot write it here? Wait a second. All. So you create allowance here. At the start of the year, right? So this is allowance. You create allowance. So anything happen during the year, if 2700 is the bad debts, you charge it to allowance, right? So you, among the total, you make a small reserve or small allowance separately. If anything bad happen, you eat that reserve so that the main big account receivable is not disturbed. Anything bad happen, it will hit the allowance. That's it. So that is the purpose, so that your planning is not disturbed, right? So let's go back to our here, right? So if anything bad happen, you charge it to the allowance, not the bad debts, right? So go back to our illustration again one more time. Let me read that one more time. So on November 30, High-Peaks party planners had 34,000 balance in account receivable, 3,000 credit balance in allowance. So that is just information. What happened? Now this is the real deal start. That is in December, they have sales 159,000, of which 130,000 has been collected. The write-off, whenever you read the word write-off, it means